Welcome to TheoTrade. This is Don Kaufman. Here we are. It's February 24th, 2018, doing the TheoTrade weekend update. Let's start with the broader marketplace. We'll look at the SPX. I'll look a little bit at volatility. Then we're going to start to move down to some specific sectors, really some risks that are facing some markets and some opportunities that I think you can really find in the midst of those risks. Let's go ahead and get started. On the SPX, all right, we see a ripping rally once again on a Friday afternoon. But what did this shortened and holiday week amount to? And for that, we're going to cruise over and we're going to add our expected moves back in. So as I zoom in over here into this drawing set, what I wanted to show you is in this shortened 4-day trading week, where did we ultimately go? Well, the line right down the middle that I'm drawing here represents ultimately where we started the week and where we, will end the week. And we ended the week mildly, again, mildly higher. So overall on this week, you're looking at what in the S&P futures, a 35 point rally. I mean, the SPX was up 43 points on Friday alone. Nevertheless, it's just getting back to just above par of where it started the week. So generally speaking, the S&Ps were largely unchanged on the week. However, we do have the Nasdaq, and we're going to actually cruise over to the Nasdaq here momentarily. Specifically, we look at the Nasdaq futures. The Nasdaq futures did do a little bit of damage, if you will, back to the upside. And again, looking at the broader Nasdaq, the rally has been much more substantial, specifically in the Nasdaq. All right, with all of this and the market rallying back up, volatility has subsided quite a bit. Now, for those of you that kind of tune in on a week-to-week basis, you'll know that I don't necessarily look at the VIX a tremendous amount because the VIX is nothing more than this calculation from the SPX options. Although it's effective, there's no skin in the VIX game, meaning that, you're not actually trading the VIX underlying, because the VIX isn't an underlying. The VIX is an equation, again, based from the SPX. So instead, I have tendency to look at the volatility futures. And what I look for in the volatility futures, something termed contango and or backwardation. Now, for those of you that do, tune in from time to time, we'll look at, and I'm going to highlight these, the volatility futures, for example, in the 25-day expiration. Then we'll jump out here to the 53-day expiration, the volatility futures, all the way, for instance, 81 days out. And what's actually happened is the volatility futures, they've kind of flattened out. Now, I'm going to draw this for people that did not tune in the last couple of weeks, Typically speaking, what volatility has looked like over the last, 5 years is something like this. And that means the shorter duration volatility futures, and these things were down at about 13. You'd look a little further out, the vol futures would be 1450, look a little further out in time, let's get crazy over here, maybe 1550, and then onwards up to 16 and change. That is what your structure of the volatility futures would look like, right? The short duration was well below the longer duration volatility futures. Again, this 13 representing, for example, the 25-day expiration, the 1450 would represent the 53-day expiration, and so forth and so on. Now, inside the last few weeks, when the volatility really struck, the futures themselves flipped over. They flipped over, which actually indicated that in the short duration, that risk was substantially higher. Like the 25-day vol futures, these things were flying. And I'll just give you a quick example. One day they were at 22. You looked a little further out in time. Maybe it dropped off to 20, looked even a little further out in time. These guys were like 1950. So again, what that indicated was that risk was prevalent right here, right now. We're on fire, we're burning, and that's what we saw the last couple of weeks. Well, right now, and again, all we're describing here is what they call contango and backwardation. I prefer to call it the volatility futures have inverted, and that means the short duration volatility futures were exceeding the longer duration volatility futures. Now, right here, right now, what are we seeing? The vol okay, is flat. For the most part, you can't read into this too much because they're almost identical. The volatility futures, whether you're looking 25 days out, whether you're looking 53 days out, okay, or whether you're looking some 81 days out, and this is what we kind of call a depth chart, they're for the most part, they're the same level, which indicates that risk right now is prevalent, but it's about the same as risk, even 144 days out. So all that really amounts to, and you're like, okay, so where do I go from here? What all that amounts to is it just points to instability. It points to like this almost angst in the marketplace. Okay. The one thing that you learn if you've looked at vol futures for years and years, when the volatility futures are inverted and the short duration is above the long duration, that means put your helmet on, we're going in, you're going to have some wild and crazy trading days. When you're seeing the volatility futures flat though, like right now, what you want to get out of that is there's absolutely, without unequivocation, no clarity to what the future holds. Okay, meaning that not from a day from now, not from, a month from now, nobody has a clue. That's why they're actually holding. I mean, again, this is skin in the game kind of stuff. So people are like, my Fibonacci show this. Yeah, well, the volatility futures have skin in the game, right? There's, billions of dollars being traded in these vol futures, and the vol futures are saying, ain't nobody know nothing right now. And I actually attribute the volatility futures being flat like this specifically to, we have a Fed chairperson that nobody has any clue right now what he holds in the bag of tricks, right? So Jerome Powell hasn't really presided over the Fed very long, has been quiet thus far, but we're going to hear from him in the next couple of weeks. And I expect that the volatility futures will remain in this relatively state of instability until he starts to speak, because the entire equity market is sitting on pins and needles waiting to see what interest rates are ultimately going to do. So again, I don't want to be dismissive, but I want to absolutely, clarify that if you think that the next move of the marketplace, well, the volatility futures are countering you and saying, no, not even the marketplace knows the next move of the marketplace. And quite frankly, I love that stuff. I mean, I absolutely love it because it's one of the hallmarks of a volatile market. And you're like, well, volatility can be up or down, but the options premiums are going to remain intact. There's going to be considerable more premium. Now, to continue with the idea of volatility, allow me to go over to the S&P futures for just a moment. And I want you to look on an intraday basis, because I know this doesn't look like all that much. You're like, okay, so we were down here and then we were up here. Yeah, but what I'm getting into on an intraday level, is how fast and how large even some of the 1 minute moves happen to be. So I don't want anybody to feel like, don't get off your guard just yet. Here, just take a quick glance. These are moves that are 3 and 4 points inside of a 1 minute candle. Now, and this is just yesterday's trade. This was a rather docile day, right? But after the cash open, take a look at some of the violence in this trade. You have to remain on guard. You have to recognize right now that the marketplace just reeks of instability. And again, the reasoning for this, number one, sure, they're like the Jerome Powell thing and the Fed, but one of the other structural changes that's happened to the marketplace, in just the last couple of weeks, the cap is no longer on volatility. All the volatility blew up. So if you looked at the XIV, the UVXY, the VXX, all of those are based off the volatility futures. Like the products themselves are constructed from the, the volatility futures, the SVXY, and all of those products, there were so many people that were short volatility that it was actually suppressing the S&P futures. So if you sold enough volatility futures, it would suppress the move of the S&P futures. Yeah, the genie's out of the bottle right now, and you can see that. I mean, here, this is a 3 point, this is a 3 minute move. Just check this out for a second. That's 3 minutes. And that's almost 10 S&P handles inside of a 3 minute move. And that's when you got to step back and go, okay, I get what he's saying. It's going to be dangerous out there. Yeah, and it's going to continue, to be dangerous on an intraday level. So if you're an intraday trader, you have to adjust your entire mindset to recognize the S&P futures, they're going to be flying around. By the way, to further something on the volatility front, okay, I also want to remind you that the VVIX, the volatility of the volatility index itself, now this matters because the VVIX is measuring options that are actually trading, okay, in the VIX. This thing is still at 110, right? So you have the volatility futures screaming no clarity. You have the VVIX screaming like, we're on fire. You're getting these wild moves in the S&Ps. And again, I think everybody kind of gets off their guard and be like, it's all okay. Come out. Okay. Come out from wherever you are. But if you looked back again at the S&Ps, even this week, I'm going to actually switch to this is a 30-day 1 hour. Okay. And just zoom into some of the moves this week. Right. And again, this week, it's kind of a shortened holiday week. And again, you're going to see a whole lot of like violent trade in here. On Wednesday in the after hours, you're like, well, what's that? That's a drop from 27, like basically 35 to 2,700. They just lost 35, S&P points. How long did it take? Well, this is a 1 hour candle. Well, how exciting. In the preceding hours, we dropped all the way down again to 2680. Mind you, that happened to be extraordinarily close to the SPX expected move for the week. All right, so let's move on a little bit out of volatility talk, and let's start to look at some opportunity in here. So again, we're seeing some massive swings on a day-to-day basis, okay? We're seeing volatility that's still, again, extraordinarily unclear as to what the future holds. And one last thing, because we're going to, as I start to get into the opportunities, one last thing I want to point out. There, in most of the recent trading weeks, has been something that hasn't existed in, years now, and that has to do with full-blown correlation in the S&P 100. Now, this is really, really important. This is the S&P 100 that you're looking at, and it's just the advanced decline line of the S&P 100. The only point that I want to make, okay, on here is that you're seeing, again, almost every stock up or every stock down on a day-to-day basis. What that means, all right, it's just when I say full-blown correlation. Look, when you have 100 products, out there, and for the most part, 98 of them are up. Okay. Do you really have to look at the individual stocks? You can start looking at sectors, but what becomes more important is that you recognize that the futures market, okay, the futures market itself is in the driver's seat. Okay. And what that basically means is on a day-to-day basis, you don't have to look that far to figure out what's moving the markets. So again, this amounts to if the S&Ps rally, everything's moving with it. That's what correlation, okay, is about. Right? And the market right now is back in this heavily, heavily correlated state. Again, another hallmark of the capability of having up moves and down moves. I have to tell you, this past week, didn't matter that the market ended on a rally. Doesn't matter that I got short positions. This past week, it's one of the best trading weeks I've had in a long time. Why? It's because on an intraday level, we got multiple intraday reversals. We're so up that we're down. We're falling down and then we explode up to sell off again. I mean, as a trader, you can't ask for any better two-sided action. Okay? This really positions me as an intraday trader kind of exciting. But I also see, again, as I'm going to break into here momentarily, opportunity in the duration. So let me get to where I see some of the opportunity. One of the biggest opportunities that I happen to see is actually really specific, and this is unusual for me because I am no fan of the Dow, right? I don't like the Dow because I don't like that, first of all, it only has 30 stocks in it. Okay. Secondly, it's not market cap weighted. Okay, the Dow is this, evil entity from which there is absolutely no escape. But when I say it's not market cap weighted, it just means this. It's the larger priced stocks in the Dow influence it the most. Okay, and there are a handful of stocks in the Dow that, and I've talked about this in previous weeks and going back, a month or so, there are a handful of stocks in the Dow that are just ripe to rip the Dow apart over the duration. Allow me to show you exactly what I'm talking about. Now, I'm going to switch my personal list. That's just a personal watch list, right? I'm going to come down over here to public, and I'm going to cruise right down to the Dow. So we're actually going to pull up the Dow itself. Okay, so this is just a Dow Jones watch list. And then I'm going to take this last price category and I'm going to sort through it. Okay, so now what am I doing? You can see Boeing, Goldman Sachs, 3M, United Healthcare, Home Depot. Okay, these are the stocks that mean the most in the Dow. But allow me to go over to Boeing for just a second. Okay, and here's where I carry a lot of positions inside of Boeing. And I'm also going to talk about those positions and what you can possibly position yourself. Here's again the bottom line. This is something I talked about again, weeks ago, and the opportunity has become even more prevalent right now. If you look at a stock like Boeing, okay, Boeing is a $356 behemoth. And the way that the Dow works, for every dollar move, okay, in Boeing, whether it moves up or down a dollar, okay, and that's Boeing itself, when it moves up and down a dollar, it impacts the Dow, for example, by plus or minus about 7 points. I don't want to go through the whole Dow divisor over here. I'm rounding. It impacts it by about 7 points. That's the actual Dow. So if you go back and you're looking at the Dow, and the Dow's, this huge index, but you have a product that is a $350 product. But now I want to go over to the option chain specifically, and you start to look out in time a little bit. Let's just go 30 days out. Okay. And I'll make a quick point. Come over here to the expected move. The expected move over the next 33 days is about, let's call it $24. Okay, so it's about a $24 expected move. And you start to realize, all right, so you have this $24 expected move times about 7. Where'd the 7 come from? Well, that's how much it would be impacted, all right, into the Dow. That is equivalent to 168 point Dow move. I know it doesn't sound like a lot, but when you start to look like a product like Boeing, if this thing has one really bad day, okay, if it has a bad day, it's probably going to move even double the expected. So now you're talking about a 50-point move. Okay, the Dow right now has this tremendous and hanging risk unto which is inescapable. And I don't think enough people are looking this direction. Now, bear with me as I get into this. So why am I describing this? I'm not necessarily telling you that you have to trade Boeing, or you have to trade Goldman Sachs, or you have to trade 3M. What I am showing you, though, is something interesting, that the Dow, if you were just long like the Dow, the risk reward makes absolutely no sense. Even if you think there's going to be considerable upside in there, okay, and I'm going to show you why it doesn't make a whole lot of sense. If you take a look at Boeing and the volatilities, they're about 27%. Okay, cruise over to Goldman Sachs. Goldman Sachs, okay, the volatilities are about 24%. 3M, the volatilities 19%. This is not exactly a volatile underlying. But then go look over at the diamonds. Now, I have no love for the diamonds. They're not even the most liquid product. But the volatility inside of the diamonds is all the way down in the neighborhood, 33 days, 41 days out. It's in the neighborhood of, about 16%. And you're like, okay, so what's the opportunity? The opportunity is a really simple one. When you have Boeing, Goldman Sachs, 3M, United Healthcare, and Home Depot, those stocks are capable of moving the Dow massively. But the volatility of the diamonds, which is the ETF for the Dow, is low on a relative basis versus the products that can actually specifically move the Dow. Okay, this looks like an opportunity to be on the buy side of premium. And throughout the course of this next week on TheoTrade, I'm actually going to be constructing a couple of trades specific to the diamonds. And I'll tell you again, I have no love for the diamonds. These things have a monthly dividend. Can't stand them. Okay, the liquidity in here it's all right. It's not stellar by any stretch of the imagination. Like, listen, people are trading it. The bid-offer spreads are, they're all right. But we're actually going to look at a number of positions throughout the course of the week. And again, if you're kind of missing the opportunity here, it's the volatility in the diamonds is low relative to that of Boeing, Goldman Sachs, 3M, United Healthcare. And you can go through all these different products, and they're all going to have volatilities that are substantially higher than the diamonds, except that the top 4 or 5 products can actually move the Dow massively. Okay, so again, there's going to be a number of different opportunities we could find in there. One of which could be, you can sell premium one product, buy premium in another product. But really, I think that the biggest and most straightforward is going to be a premium buy inside the diamonds. The Dow itself right now, I will reiterate this message. The Dow itself right now looks like it's about to substantiate some heavy amounts of risk moving forward. So if you're heavily vested towards, again, Dow underlyings, you need to take that into consideration right now. All right. So we looked a little bit at a couple of Dow underlyings. We looked at the volatility futures. We looked at a bit of an opportunity. Okay. Last but not least, let's examine once again the expected moves, okay, kind of moving forward on the week. And to do that, we're going to go to the SPX. I'm going to close up this left side bar, and we're just going to go about 6 days out. And I want you to see the expected move, okay? It's contracted. It's about $43 right now. It's about $43, okay? And what that amounts to over the next, 5 trading days, we're supposed to move about $43 higher or lower. Now, again, to kind of orient yourself with that, how does it compare to the previous week? Well, this previous week, we had right in the neighborhood, okay, right in the neighborhood of about a $53 expected move. But remember, that was over 4 days. Here, we're getting into plus or minus about a $43 move. So volatility has contracted. And notably so, listen, even though we had some wild intraday trading sessions, we didn't really move higher or lower. I'll kind of finish with this last irony on here. You're seeing the interest rates, the TNX, okay? You're seeing the TNX flirting with this 3% level. Frankly, I expected it to hit the 3% level this week. But you're seeing the TNX come up and flirt with levels that haven't been hit in years. And then you look back at the volatility futures, okay, which we looked at. And those volatility futures, again, what did they indicate? Complete and utter uncertainty. You look at the VVIX. The VVIX is still screaming. There's a fire burning. And yet the SPX, what does it do throughout the course of the week? Waffles back and forth violently. Okay. This, again, should be a shot across the bow a little bit. And you got to stay on your guard. It's one of the most important things, not even just on an intraday basis, but recognize, okay, I do not believe this week, in the coming week, that we hold this range in the SPX. Okay, there's too many announcements coming out. Again, we have a full economic calendar out there. You're going to start to hear some more Fed speak. Okay, it's also the beginning of the month. Again, full economic calendar. Even though we have a $43 expected move, I'd be extraordinarily careful this next week. I do actually believe that we are going to be cracking the range. Now, again, as I said, there's absolutely no clarity as to the bias of a marketplace when the volatility futures are flattened like this. Okay, I maintain longer duration bearish positions in the marketplace. Okay, I've actually shifted some of my own allocation in bearish positions though now towards Dow futures. I see the most opportunistic short position is likely to be to the Dow futures moving forward. I want to thank everybody for joining us here at TheoTrade on the weekend update. Have a wonderful weekend. Bye-bye.